President Mester, thank you so much for joining me. It's great to have you on the program.
It's my pleasure to be here. Thank you.
I want to kick off the conversation with what we learned in the Fed minutes last week, which is that Federal Reserve staff are now expecting a mild recession later this year as a result of bank failures and the potential for ensuing credit tightening. Do you share that assessment?
So my view is that, growth will be very slow this year, well below trend. And when you have growth that's that slow, it doesn't take much of a shock, something comes up that could push you into negative territory. So I think, it's a matter of, I think the overall trajectory is slowing growth. We also are going to see perhaps some slower employment growth. We've seen that come down some over the past year, and I think that'll continue. But I also think we're going to see material improvement in the inflation side. So what's happening is there's this rebalancing in both product and labor markets between demand and supply. And that's what it's going to take to get inflation on that sustainable downward path to 2%. So I think there's been progress, and I think we'll continue to see progress this year.
So then what are you seeing now as far as credit conditions? We learned in the Beige Book that banks have tightened lending standards across several districts. Do you think that things could get worse from here, or is it largely contained?
Well, let's take a step back. So certainly the banking industry is strong and resilient and sound. We did see in mid-March some stresses at a small number of banks. And then we had the two bank failures, Silicon Valley Bank and Signature Bank. And those failures really led the Fed and the Treasury and the FDIC to take actions to ensure that the problems in those banks, in those small number of banks, wouldn't be contagious, all across the system. Mm-hmm. And so we set up a new lending facility, a liquidity facility for banks, and we also have our traditional discounting lending. And those actions have reduced some of the March stresses we've seen in the industry. So that's a good thing. Now, even before the stresses in the banking industry in March, banks were already beginning to tighten their credit standards. And that's because interest rates have moved up. But that's the typical way that monetary policy transmits into the broader economy. So the question now going forward is, will stresses in the banking industry, those stresses in March, lead banks to move faster to tighten their credit standards? And if so, credit will become less available. And that has the same kind of impact on the economy as tightening of monetary policy. So we're doing that assessment. We're continually engaging with bankers. We also have some surveys that we do. And that'll be part of the discussion at the upcoming FOMC meeting to really assess not the magnitude of those effects and what the expected duration of those effects will be. And that'll influence how we think about the future path of monetary policy.
So when you're weighing credit tightening versus inflation, and I know you said in a speech earlier today that inflation still remains too high, which is sort of the bigger problem right now that you see when it comes to setting monetary policy?
Well, inflation still is too high, as I said, and I said in the speech. We've seen some progress there. If you look back, at the peak in inflation last year, we're down from that in terms of the headline inflation numbers. The core inflation measures that really look at the less volatile components, they've made less progress, but nonetheless some progress. But the levels are still too high. And so what we really need to do is we need to make sure that we get that inflation rate on that sustainable downward path. So that's my focus. The tightening of credit conditions, either from the Fed or perhaps from banks tightening their lending standards more, is a mechanism for getting that done. And that's the evaluation that we're going to be doing at the upcoming meeting to make sure that we're on a path. The underlying economy has shown resilience to the rate increases we've done already, and also over the pandemic period, it was more resilient than I think a lot of us had feared at the very beginning. So so far it's been quite resilient. And now we just have to make sure that we get the job done on inflation. And that's what it's our responsibility at the Fed to do.
So, given that, you said that you think rates need to rise above 5%. The median projection is 5 to 5.25 on the peak Fed funds rate. Does that level make sense to you, or do you think that the peak on the Fed funds rate needs to be higher than that range of 5 to 5.25?
Well, we'll be evaluating that in our meeting. I do think that given where inflation is, and given how stubborn it is, and given the strength, the still strong labor market, I do think that rates are going to have to move up to 5, above that 5% level. But how much they have to move up and for how long they'll have to remain there, that's what the economy is going to tell us. The economic developments, financial developments, those developments are going to inform, right, the future path of policy. So I think at this point, that's where I'm there. But as information comes in, and we look at a lot of information, not just the official statistics, but also a lot of reports that we get and information we gather from contacts in our district, whether they be businesses, community contacts, labor market contacts, that information is going to tell us, where policy should go, and we're going to take that into account when we make our next decisions.
But is there a risk to the upside in terms of the policy path there?
Well, again, we're going to just be evaluating that going forward. I mean, the median path in the SEP, which what you were pointing out, was the median across all the participants. We come into every FOMC meeting, looking at all the information we've gathered in that intermeeting period about how the economy is evolving. And that helps inform our outlook. So we'll go into the meeting and we'll talk about not only policy at the current meeting, but also where we think the path's going forward. So that's just what we typically do in an FOMC meeting. And then we articulate the outcome of the meeting in the policy statement that comes out after the meeting. And of course, Chair Powell has his press conference at which he explains more about the thinking of the committee.
I know we still have some time till the next policy meeting. You're still going to be poring over the data, and certainly a lot changed in the intervening period last time around with SVB's failure. But given the data in front of you today, would you lean towards tightening at the next policy meeting?
Well, as I said, I think we do need to get the rate above 5% in order to be assured that we're going to have inflation coming down back to our goal of 2%. But I don't want to give sort of a decision now when there is more information coming in, and we'll have the discussion in the meeting. But that's where I am now. And then again, we're going to gather this information, including, the assessment of, the tightening of bank lending conditions and the effects those may be having on the economy as well.
Are there certain conditions that would warrant having you pause and wait perhaps another meeting?
Well, again, what we always think about when we go into a meeting is what's the appropriate path of policy that'll meet our dual mandate goals of maximum employment and price stability. And one of the things that happened before the March meeting is that we did take actions, the Fed, Treasury, and FDIC, to really make sure that financial markets and banking markets remain stable. And that was a very important thing to do. And the Fed is on record as saying, the chair said this several times, and Michael Barr, the vice chair of supervision, that we're prepared to do more with our macroprudential tools to make sure that the financial system stays stable. And that's a really good thing, because if we use our macroprudential and microprudential tools, including bank supervision and regulation, to keep the banking system sound and healthy and keep the financial markets, working, then we can use our monetary policy tools to focus on the macro economy and our monetary policy goals of price stability and maximum employment. We had that opportunity at the March meeting, and I expect that we'll have that opportunity going forward.
Switching gears, I want to ask you about women and the economy. Some recent research from Bank of America showed that women are at a risk of real wage losses. They say in that research that they're less likely to get raises that keep up with inflation. At the same time, Treasury Secretary Yellen has said that women who have full-time jobs in this country only earn 83 cents on average on the dollar compared with their male counterparts. President Mester, why are we still dealing with this? How do we close the gap? And would this not help economic growth if we close the gap?
Well, it certainly would help economic growth if everyone could enter the workforce and be productive and gain education, that they could actually be a very productive member of the workforce, especially as jobs change. So there's no doubt about that we want to have everyone who wants a job to be able to enter the labor force and, really produce to their potential. And that there's no doubt about that. Women are disproportionately harmed by the fact of childcare not being available and not being available at an affordable price. There's no doubt about that either. The Cleveland Fed has done some work on this. And there's a number of ways that women are, their labor force participation is hurt relative to men. One of them is the cost of childcare, because in this country it's still more of a woman's responsibility to care for children than a men's. Another is sort of the tax treatment of married versus singles. And a third factor they found was just the allocation of Social Security benefits. So those weigh on labor force participation in women. And if we could do things to get women into the labor force, it would definitely, help productivity and therefore the longer run growth of the economy. The gender pay gap is smaller than it was in the 60s, but there's still more work to do. Of course, some of the gap is because women have different types of job, work in different sectors relative to men. Of course, some of that is driven by the fact that women do have childcare responsibilities, and childcare isn't as easy to find. So again, this is a complex problem. There's multiple things that have to be done to solve it. I think I'm always a fan of making sure that people have the opportunity to get educated or to take training. And I think that's been found over time to help close that gender gap. But we need to do more. And I think there's a number of things that every firm can do to make sure that we are giving women equal opportunity to men to be a productive member of the labor force.
And President Mester would love to continue that part of the conversation with you at some point in the future, but unfortunately we'll have to leave it there. Thank you so much for your insight. I so appreciate it. Hope to talk to you again soon.
Thanks for having me. I really appreciate it.
That's Loretta Mester, president of the Cleveland Federal Reserve. Back to you.
All right, Jennifer, great interview. Thanks so much. And of course, our thanks to Cleveland Fed President Loretta Mester.